SMSF,
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 in SMSF.
I've seen a 25% increase in inquiries at my accounting firm about using self-managed super funds to make property ownership more achievable. Most people sign up for super as a necessity, trusting institutions to manage their retirement savings. But a lot of them are starting to realize that they lack a clear picture of what's happening behind the scenes, or they don't trust these institutions to get it right with their money. And with the cost of living crisis hitting us really hard, more people are trying to take an active role in their retirement investments and figure out how they can leverage it to buy property. If you're watching this, you're likely one of them. So I decided to make a video to give you the most comprehensive breakdown of number 1, how you can buy property with your SMSF. Number 2, the tax benefits. Number 3, the responsibilities and risks of managing your own super. So are you ready? Let's get started. Let's start with the basics. How it works differently from other super funds. An SMSF is a private super fund that you manage yourself. It gives you the power to make your own investment decisions and control your retirement savings, which is exactly why I pointed out earlier that they're becoming more popular. More and more people want control and flexibility over their funds. With an SMSF, you're in the driver's seat when it comes to your investments. You can tailor your investment strategy to your specific goals and risk tolerance rather than being limited by the one-size-fits-all approach of many traditional super funds. Another big advantage of SMSFs is the ability to invest in a wider range of assets. You could even invest in crypto if you wanted to. This is a bit tricky and needs another video, but it's something you can do. This level of diversification and more customization is a major reason why so many Aussies are choosing to take the SMSF route. As people become more educated and more informed about their finances, they're realizing they don't have to rely solely on big institutions like banks and super funds. Instead, they can take a more active role in managing their retirement savings, growing their wealth, and securing the financial future through SMSFs. Another major appeal is being able to buy property using your SMSF. When you do this, your fund will own the property and not you. The purpose of the purchase must be to benefit your retirement. So that means you're limited to only being able to rent it out, and you won't be able to live in it along with any other close family and friends. One of my favorite things about SMSF is the fact that it is allowed to borrow money to purchase property. You're not just stuck with the cash you have in the super fund balance. So if you don't have the borrowing capacity to buy a property in your own name, you could use the SMSF to do this. Using leverage to purchase a property can mean you can supercharge your investments and get a better return year on year. Of course, managing your super fund comes with its fair share of responsibilities and challenges, which we'll look at later, but for many people, the benefits of greater control, flexibility, and the potential for better returns makes the efforts worth it. SMSFs offer some significant advantages over traditional super funds, but it's important to weigh these benefits against the potential drawbacks and responsibilities that come with managing your own super fund. Let's talk about these drawbacks actually. One of the biggest drawbacks is the cost. SMSFs can be expensive to establish and maintain, especially if you have a lower balance. In fact, it's been often advised that you should have at least a minimum balance of $200,000 to make an SMSF cost-effective. There's also added responsibility and workload that comes with being an SMSF trustee. This means that you're legally responsible for managing the fund and ensuring it complies with all the relevant super and tax laws. And trust me, there are a lot of things you need to comply with. For example, one of your key duties as a trustee is to create and regularly review your fund's investment strategy. This strategy is essentially a roadmap for how you plan to invest your super savings to achieve your retirement goals. Your investment strategy should consider your risk tolerance, investment time frame, and asset diversification. As a trustee, you'll also be responsible for keeping accurate records of your fund's transactions, investments, and member balances. This includes things like minutes of trustee meetings, financial statements, and tax returns. You'll also need to hire an independent auditor each year to review your SMSF's financial statements and compliance with super laws. This audit is a legal requirement and helps to ensure your fund is being managed correctly and transparently. Your auditor will check things like your SMSF's investments are in line with your investment strategy, whether you kept proper records of transactions and decisions, and whether you've met all your reporting and compliance obligations. Once your audit is complete, you'll need to lodge an annual tax return with the ATO. This return includes your SMSF financial statements, member statements, and the auditor's report, and is used to report your fund's income and expenses and tax liabilities for the year. It's also important to keep accurate records of all your SMSF transactions, investments, and member balances throughout the year. This includes bank statements, invoices, contracts, and minutes of trustee meetings. You'll need to keep these records for at least 5 years, in some cases, even longer. As for the compliance with super and tax laws, this includes things like not exceeding your contribution caps, not accessing your super savings before you're legally allowed to, and not investing in prohibited assets like artwork or wines. If you fail to meet your trustee obligations or comply with relevant laws, you could face some serious consequences. Penalties can include fines, tax penalties, or even you go to jail. In some situations, your fund could be declared non-complying, which means you lose your tax concessions and you could be taxed at the highest marginal tax rate. And that's the most important thing. Given the risks and complexity, you'll need to educate yourselves about your responsibilities as an SMSF trustee and get professional advice. Let's talk about the withdrawal rules and contribution caps. The rules for withdrawing from your SMSFs are pretty much the same as those for any super fund. You can start withdrawing your SMSF benefits once you reach your preservation age and you meet a condition of release. Your preservation age is the age at which you start accessing your super. Provided you've also met the condition of release, this age is different depending on your date of birth, but for most people, it's 60 years old. Some common conditions of release are retiring from the workforce, reaching age 65, or becoming permanently incapacitated. In some cases, you might also be able to access your super earlier due to severe financial hardship or compassionate grounds, but these situations are less common and subject to strict eligibility criteria. Once you've met a condition of release, you have a few options for withdrawing your SMSF benefits. You can take a lump sum payment, start an account-based pension, or even do a combination of both. The right option for you would depend on your individual circumstances and financial goals. So if you decide to take a lump sum, you'll be able to withdraw some of your super savings as a single payment. This could be a good option if you have a specific purpose in mind for the funds, like paying off debt or investing in property outside of super. Alternatively, you might choose to start an account-based pension which provides you with a regular income stream in retirement. With an account-based pension, you'll be required to withdraw minimum amounts each year based on your age, but you have the flexibility to adjust this as payments are needed. Normally, if you reach the right criteria, these pension withdrawals are tax-free. The same general rules also apply to contribution caps with SMSFs. There are a few different options available to you. The two main types of contributions are concessional before tax and non-concessional after tax. Concessional contributions include things like employer contributions, salary sacrifice payments, and personal contributions that claim a tax deduction for. These contributions are taxed at concessional tax rate of 15%, which can be a big tax savings compared to your marginal tax rate. But there's a limit to how much you can contribute as concessional contributions each year. The concessional contributions cap for the 2024 to 2025 financial year is $30,000. So if you go over this cap, you might have to pay extra tax or even withdraw the excess contributions you've made to your fund. Non-concessional contributions are made with after-tax money, so aren't taxed again when you put it in your super fund. This includes things like personal contributions that you don't claim tax deduction for, and spouse contributions. Like concessional contributions, there's also a cap on how much you can contribute as a non-concessional contribution each year. And so the non-concessional contributions caps for the 2024 to 2025 financial year is $120,000. Apart from contributions, you can also transfer money from other super funds into your SMSF through a rollover. This could be a good way to consolidate all your super savings and take advantage of the benefits of an SMSF. There's also a few more do's and don'ts I want to share with you based on my experience. First and foremost, create a well-diverse investment strategy that aligns with your goals and risk tolerance. This means spreading your investments across different asset classes and not putting all your eggs in one basket. But just want to let you know, I'm not a financial advisor, so this is just further information. Another important do that I can't stress enough is take record keeping rules seriously. As I mentioned earlier, you will need to keep track of all your SMSF transactions, investments, and the member balances and be able to provide this information to your auditor and the ATO. Having a good record keeping system in place will make this process for your accountant so much easier. So we can help stay on top of your compliance obligations. There are also a few things you should definitely avoid when running an SMSF. One big no-no is trying to access your super savings before you're legally allowed to. This is called illegal early access and can result in harsh tax penalties and even disqualification of your SMSFs, which will cost you a lot of money. Another thing to be really careful of is exceeding your contributions caps. As I covered earlier, there are limits to how much you can contribute to your SMSF each year before and after tax. Keep track of this. If you go over these caps, you could be in for a painful surprise when it comes tax time. Alright, so now you know the basics of SMSFs, but there's one more aspect we need to talk about. Setting up an SMSF. It's not as simple as just clicking a few buttons and calling it a day. There's a right way and a wrong way to do it, and trust me, you want to make sure you're doing it right. So if you're keen to get started, click on the video in the top right corner here. We'll walk you through setting up your very own SMSF. Alright folks, that's it. See you guys soon.